Vicky Pryce, Senior Managing Director of Economics at FTI Consulting, joins us now. So when you look, as we reach the end of 2011, we head into 2012, how do you view events in Europe and in the UK? Let's start with Europe because there's so much going on there. Is the glass half full or half empty?
Well, there's an awful lot more to do. We have this new government, of course, in Greece and Italy, but the markets are still very worried. There's no doubt about that. The institutional framework has still got a long way to go. I think there are concerns about whether, in fact, the ECB, the European Central Bank, will step in and do the right thing, which in my view is start buying government bonds, or certainly the Italian bonds and others, in a big way.
And when you say we've got a long way to go in terms of the institutional framework, is that something that we are paying enough attention to right now, or that Eurozone policymakers are focusing on? Do they have the right tools for the job, if you like?
Well, they're focusing on it, but they're not actually necessarily reaching agreement, and that's the real problem. We've seen divisions between France and Germany. We've seen the concern that people like Obama have in terms of getting their act together, and really they are around a number of issues, in particular the role of the European Central Bank and the concern the Germans have that if they do quantitative easing, which is what we like them to do, we end up with hyperinflation again, and that is something that needs to be sorted out.
How difficult is it going to be to resolve that dilemma? Because it looks as though, just going by the comments from Bundesbank President Jens Weidmann over the weekend, if anything, it looks as though the German position is hardening on that.
Well, the German position has hardened on a number of issues before, and then at the last minute they do the right thing. So I think at the end of the day, the needs of the Eurozone are going to be supreme, and if the markets continue to behave as they are, I think people will realise that a solution needs to be found. So I see no other way out except for the ECB in the short term to be allowed to be doing what it should be doing. But of course then we need to be looking much more closely at what the EFSF is going to be doing, which is the Stability Fund. And that needs to be increased very substantially in terms of size, and that hasn't really happened. The system of increasing it, exactly what is going to work in that area, has just not been developed at all. And the real, I think, depressive fact of the G20 meeting in Cannes is that there was just no agreement on how exactly we can get enough firepower in Europe to ensure that the confidence in the markets is restored, and Italy needs that confidence to be restored.
Do you fear that we're moving into a new stage in the crisis where core countries are becoming increasingly vulnerable to what we've seen in the peripheral bond market?
Well, I'm afraid so. A number of us who have been saying, in fact we discussed that in the Centre Forum Bloomberg event that you just mentioned, we've been saying for about a year that things need to happen very quickly in Greece so that we wouldn't get contagion. Contagion has happened. We're now seeing what's going on in France, for example, and people are beginning to worry about the French debt situation as well, and austerity measures there are also important. So, yes, it's spreading. It's spreading across Europe, and that's the real difficulty at present.
How concerned would you be about France right now?
Well, not hugely. But you see, the banks, the interesting thing about them is that the banking system is one of the most exposed to the periphery countries. They've already been writing down their debt, frankly, and they're moving up. Yes, and of course the French banks bought into Greek banks thinking it was all going to be fantastic from here on, and it has proved to be a big mistake for them.
And you're saying that you're worried about core European countries. If we do see bond markets deteriorate for them, does that render the EFSF largely futile? And therefore we get back to this issue of institutional building in Europe?
Well, that's a very, very good point. If the ECB doesn't do anything to calm the markets down in the short term, then yes, we're ending up with a position which says we can't actually have enough firepower there to deal with the big countries. And that's the real problem. But you don't necessarily need to have all that money. What you really need to do is tell the markets, or at least instill the confidence in the markets, that you would be there to intervene if necessary. And everything that's happened so far has been wrong in that area. They haven't actually given that confidence to the market. So you don't actually need the cash, if you like. You just need the commitment and to assure the markets that you will step in as necessary.
Beyond the immediate euro debt contagion issue that that everyone seems to be immersed with right now, beyond that, there is a genuine problem with growth and competitiveness. Even if you were to resolve all of this today or tomorrow, there would still be considerable challenges in this region.
Well, growth and competitiveness are two slightly separate things, even though clearly the more competitive you are, the better you do. But even countries which are very competitive, like Germany, are facing now a slowdown. Yes, they didn't do too badly in the third quarter, but they're slowing down quite significantly in any case. The periphery countries have a serious problem of competitiveness. During the whole Eurozone period, they ignored that. They actually focused very much on just spending because they had no longer a deficit problem to worry about. A balance of payments deficit problem is what I'm talking about. So they could just, they didn't worry about their currencies, sort of needing to devalue if they bought more than they sold in the sort of trade area. So they bought very happily German goods and other goods. And that meant that instead of focusing on improving their own sort of productive capacity, they actually sustained the core countries in Europe, which is quite interesting, really, and ironic. And that is something that needs to be addressed, and hopefully, over a period of years it will. But it's not going to happen overnight, so we're going to have the problem of growth in Europe for some time to come. In addition, of course, you have the problem of credit constraints right now. Banks are not lending to each other, so a new credit crunch has appeared, and that is a problem for all countries in Europe.
It's a problem for all countries, including as well the UK, and we had some rather grim comments from Governor Mervyn King just yesterday about a weak outlook for economic growth in, well into next year, halfway through next year. And concerns about the risks from the Eurozone debt problem as well. So what about the challenges facing this country right now? Is the government doing enough? Of course, they are obsessed with fiscal consolidation. Is that the right way forward?
Well, they're right to want to continue on that path overall. I mean, the general path, which will keep the markets reasonably happy. But the problem, of course, in the UK has been that growth has been slowing down in any case for quite some time, partly for internal reasons. We've had sort of consumer spending constrained because of real living standards have been declining, inflation has been high, wages have been low, we've had a cut in public spending, we've had exports being reasonably high, but net imports also being high, which means that net trade was not contributing to growth. Investment has been so-so. So there hasn't actually been an engine of growth there, and everyone was already looking at the November 29th budget as statement, rather. The budget will be next March, to do something in the economy and set us back on a path of growth. Now, that's becoming much more difficult because of the Eurozone crisis, obviously, but already everybody had downgraded the forecast. I think the Bank of England has been below the trend, if you like, or at least behind the trend, hadn't downgraded its forecasts sufficiently so far, and now they've downgraded them very, very significantly, by 1.2 points for next year because of the Eurozone. But we mustn't sort of over-exaggerate this, because actually the UK economy was already slowing down. Looking ahead, of course, the Eurozone matters. So what can you now do on your own in terms of addressing this bit difficult?
Well, thank you very much. You really put that into context for us. Vicky Pryce, Senior Managing Director of Economics at FTI Consulting. Thank you.